How much should you set aside for taxes if you have a small business? Hi, my name is Nicole Green. I'm a tax advisor at Robert Hall and Associates. Today, we're going to talk about what you should set aside when you have a small business. We're going to discuss how you need to estimate your tax liability, how much should you set aside in your personal income if you have a pass-through entity, and ways for you to figure all of this out, tax software that you can use, and other handy things. As always, don't forget to like and subscribe. Okay, let's get into it. How much should you set aside for taxes if you have a small business? First, we need to establish what type of business do you have. Are we a sole proprietorship? Are we an LLC? Are we a single member partnership? All of those don't matter. That's just like LLC. Or are you an S Corp or a C Corp? Okay, we're going to start with C Corps because that's the atypical one. A C Corp is its own entity, just like an S Corp, but a C Corp is a complete entity and it's not a pass-through entity. That means C Corps pay their own tax. The other types of entities, LLCs or S Corps or sole proprietorships, obviously, are going to not pay tax. They're going to pass that tax to you on the personal side. While it's a separate thing, it still doesn't actually pay much in tax. You pay tax on the income on your personal side. Think of pass-through entities as like a filter. All the income goes into the pass-through entity, whether it's an LLC or an S Corp, and then the S Corp or LLC will determine how it should be taxed and will determine the category of income that will qualify it for and what can be applied to it and all of the stuff. And then once it's done filtering it out, it'll dump it into your personal return, and that's where the tax is. But a C Corp is no filter. A C Corp will pay its own tax. It could change. It has changed before, but the amount of tax that it pays. Right now, it's 21%. It changes roughly 3 years or so, depending on the economy and depending on the political makeup of our government. And so currently, it's 21%. And then the C Corp will pay all tax on the profits of the business, and any income that you take out of the business, you will pay at your own tax rate. And you can take that income out as a W-2, where you're going to pay income tax and payroll taxes on it, or you can take that income out as a dividend payment where you're just going to pay income tax. Depending on how active you are in the business will determine how that income can get distributed to you. You can also do both. Okay, so then that's C Corp, and then there's the S Corps and the LLC as pass-through entities. As I said, think of it as a filter. All the income goes inside, and then it dumps out, gets cleaned, washed, lessened, reduced, and then it goes into your personal, and that's where you pay the tax. And so understanding the tax liability is really going to be quite easy once you understand what your net profit is, or what your net income is, or what your profit is. Okay, so that is a C Corp. Let's talk about the other types of entities, the LLCs or S Corps. As I said, they're pass-through entities, so you think of it as like a filter. All the income goes in, it gets cleaned, reduced, and then it gets dumped out into your personal, and that's where you pay the tax. And so what you first need to do is understand what the net income or the profit of the business. The net income is the amount of income you have minus the expenses. That's net income, that's the profit. And so once you understand what that is, you will understand how much of tax you're going to pay. If you're an LLC, you're going to pay 15%, 15.3% on all of the profits as self-employment tax, and then you'll pay whatever your tax rate is. If you're an S Corp, you're going to run a payroll, and that payroll will determine how much you run a payroll, usually about a third of whatever your profits are, and to payroll, you will end up paying about almost the same, almost 15% in payroll taxes, whether you pay it on the employee side or the employer side. I don't want to get too much into it because that gets a little technical. But altogether, it still ends up being roughly 15%. And then you pay income taxes on that total profit. Let me give you a really simple, easy example with some round numbers. Let's imagine that we have $100,000 of profit. If we have $100,000 of profit in the LLC, we're going to pay $15,000, $15,300 in self-employment tax. We're going to pay $25,000 in federal income tax, and then whatever your state tax is. I'm in California, and so it would be like $9,300. If you have an S corp, you're going to run a payroll for, let's say, 40,000. So you're going to have about 6,000 or so in payroll taxes. You'll pay the 25,000 and the 9.3% or the 9,300 in income taxes. If you're a C corp, you're going to pay 21% on that whole thing, and then whatever your state corporate tax is. And so you'll pay 21,000, and then whatever your state corporate tax, let's say California, we're still at the 9.3, and so you'll pay it there. However, on the C corp, remember, you didn't actually get to use any of the money. With the pass-through entities, you're totally able to use the money. It does not save you taxes by not using that money for personal expenses. On a C corp, you can only use it for business expenses. If you use it on the personal side, you pay the personal taxes. How much should you set aside? Because this can be a little much. I understand that. You really should set aside about 20% of gross when you're first understanding what your business is going to do and when you're first getting acquainted of how you are taxed for your business. This is very, very important for people with S corps. About 20% of gross, and even with people with LLCs, about 20% of gross is going to kind of cover people in both of these boxes. 20% of gross will be just a little bit under what you owe in taxes on the if you're in an LLC, because self-employment is going to be 15.3%, and then you have also your income tax. But remember, I'm saying 20% of gross, 20% before expenses. If you have an S corp, it's going to definitely cover all of your taxes unless you make, I think, around 1.4 million is where that number gets skewed a little bit. But anyway, it covers 20%. 20% covers the taxes, and then it allows also a little bit of extra money for you to put into retirement. When you have a business, it's so important that you're putting money into retirement because you don't have other people actively doing it for you. When you're on W-2, you have other people, if you have benefits and stuff, and your company will actively be helping you out in some aspect of retirement, or you're depending on Social Security. And when you have a business, your Social Security gets reduced a lot because we try to save people on self-employment tax and payroll taxes, and thus your Social Security that you're able to pull from when you get old is going to be greatly reduced if it still exists. But how can you help track all of this information? The easiest and best way to track all of this information is to take an hour and a half, maybe 2 hours, and sit with your tax advisor towards the end of the year between Halloween and Christmas. It's so easy that way, so that you can then make sure you're prepared and you're doing things correctly. You could also, or in combination, use some tax softwares. QuickBooks is a great tool to use. Quicken is also amazing. Spreadsheets work really, really well. They're a little bit more labor intensive. QuickBooks has a little bit of a learning curve because you have to get used to how to use the system. Quicken, people do technically find it to be a little bit more user-friendly, specifically if you're if you're an Android user, you might prefer Quicken. It's very much more granular. It's very much not as aesthetically pleasing as maybe QuickBooks is. I would say QuickBooks is like the iPhone, and then Quicken is like Android. Xero is like a whole computer. So whichever program you're trying to use really isn't that big of a deal. The program that you should be using is whatever suits your needs the best, whatever you're most comfortable with, because you need to do it. You should be reconciling your books on from your business account regularly. That's not quarterly. It should be done way more often than quarterly, maybe monthly. Sometimes people do it daily. That's a little much, depending on how many transactions you have. But I would say definitely regularly. One, you need to just be keeping up on what's happening inside your business. We don't want any of those extra charges going through and not noticing them. And then, of course, you need to know where your profits are. Not how much income do you have, but profits. How much profits do you have? Because obviously you have expenses coming. So spreadsheets may be really great. A lot of accounts, also like banks and credit cards, do really nice summaries. And if you spend a little bit of time digging into them, you can be quite specific. And so because the banks like it when you keep everything into with them, because they want to use your money and lend it out, whatever. I'm going on another tangent. So the banks, because they want you to keep your money, and they're creating more financial software for people to use that's built into your actual online banking tools. And so you might want to use that and then just throw it into a spreadsheet if that's easy for you. But at the end of the day, understanding what your numbers are so that you can then give it to your tax advisor, so that your tax advisor can show you how you can minimize that tax, when it's better for you to go from an LLC to an S Corp, or should you go back from an S Corp to an LLC, or does it actually serve you a benefit to be a C Corp and have that 21% and you not touching that money, or touching the money because of why? I don't know. There's definitely reasons for you to determine which of those three entities to be. But for the first two, definitely look at the profits. And you're going to be having 21% of gross to set aside. For the C Corp, you're going to set aside whatever your tax rate is on the state tax, and then 21% if that hasn't changed yet. On the federal side, you can just know what that is. But 20% of gross for the majority of small businesses is what you should set aside. And that will cover your taxes mostly or completely. If you still have questions, or you would like to have a tax planning appointment with me so we can estimate your taxes and see if we've set enough aside, throw some money into retirement, please don't hesitate to click the link in the description box, or you can go to our website, roberthalltaxes.com/contact, and we'll set up an appointment. Thanks!